Distribution entities serve as vital intermediaries in multinational enterprises, facilitating the flow of goods and services from manufacturers to end consumers. The nature of these entities varies based on their roles, the risks they assume, and their financial outcomes within the value chain. This article examines the three primary types of distribution entities: agents, limited-risk distributors, and fully-fledged distributors, and explores their distinct functional profiles, risks, and rewards. Contract manufacturers operate under the direct control of a principal company. Their primary role is to produce goods based on the instructions provided by the principal, who supplies the raw materials and retains ownership of the finished products. The operations of a contract manufacturer are limited to routine production activities, with minimal exposure to market or inventory risks. For example, if production is delayed or there are quality issues, the operational risks are borne by the contract manufacturer. But broader market risks, such as price fluctuations or demand variability, remain with the principal. These manufacturers are typically remunerated on a cost-plus basis, ensuring a predictable return for their limited functional scope. A typical scenario might involve a European manufacturer producing automotive parts for a global company, following strict specifications and earning a predetermined markup regardless of market conditions. Moving to limited-risk distributors, these entities perform a broader range of functions compared to agents, but their scope and risks are still restricted. A limited-risk distributor takes ownership of inventory and sells products to customers in a defined market. However, it operates under the tight control of the principal, following strict pricing, marketing, and operational guidelines. While these distributors assume some degree of inventory risk, the principal typically retains the majority of strategic and market-related risks. For example, a limited-risk distributor in a European market may handle the sale and delivery of consumer goods, but rely on the principal for marketing campaigns, pricing strategies, and supply chain management. The distributor's primary risks are tied to inventory management and operational efficiency, such as ensuring timely deliveries and maintaining quality standards. Their compensation is based on a cost-plus or gross margin model, providing a predictable return in line with their functional and risk profile. In contrast to agents and limited-risk distributors, fully-fledged distributors function as independent entities within the value chain. They purchase goods from the principal and manage all aspects of distribution, including inventory, pricing, marketing, and customer engagement. These distributors bear substantial risks, such as market risks, credit risks, and inventory risks, and are responsible for the profitability of their operations. For instance, a fully-fledged distributor managing a portfolio of luxury goods in North America might invest heavily in market research, promotional campaigns, and distribution infrastructure. It would also have the discretion to set prices and negotiate with key retailers. Unlike agents or limited-risk distributors, fully-fledged distributors retain the residual profits after covering their costs, reflecting their entrepreneurial role in the value chain. From a transfer pricing perspective, the functional differences between these distribution models have significant implications for profit allocation. Agents, due to their limited scope, earn routine returns through fixed commissions, which are benchmarked against similar service providers. Limited-risk distributors, while slightly more exposed, also receive routine returns, with compensation reflecting their limited exposure to risks and operational responsibilities. Fully-fledged distributors, however, justify retaining residual profits through their assumption of entrepreneurial risks and their broader contributions to value creation, such as market development and brand positioning. A critical challenge in transfer pricing lies in accurately documenting and defending the functional profiles of these entities. For agents and limited-risk distributors, the limited scope of their functions and risks must be clearly established through intercompany agreements and supported by financial and operational data. Fully-fledged distributors require a more detailed analysis, as tax authorities may scrutinize their profit levels to ensure that they reflect the risks and functions performed. Misalignment between the functions, risks, and rewards of these entities can lead to disputes, adjustments, and potential penalties. Economic and regulatory developments are also reshaping the landscape for distribution entities. The OECD's BASE, Erosion and Profit Shifting, BEPS, initiatives have heightened scrutiny on low-risk models like agents and limited-risk distributors, ensuring that their compensation aligns with their functional contributions. Fully-fledged distributors, on the other hand, must adapt to competitive pressures, shifting consumer behavior, and the increasing role of digital tools in distribution. Technological advancements are also influencing distribution strategies. Digital tools for inventory management, customer analytics, and demand forecasting are enabling distributors to improve efficiency and add value. For agents and limited-risk distributors, these tools may enhance their operational performance without significantly altering their risk profiles. Fully-fledged distributors, however, may integrate these technologies into their entrepreneurial activities, further blurring the lines between traditional models. In conclusion, agents, limited-risk distributors, and fully-fledged distributors represent distinct models of participation in the value chain, each with its own functional and risk profile. Agents, as intermediaries, focus on facilitating transactions and earn predictable commissions aligned with their limited role. Limited-risk distributors expand on this role by taking ownership of inventory and handling sales, but remain constrained by the principal's strategic oversight. Fully-fledged distributors, as independent entrepreneurs, bear substantial risks and claim residual profits, reflecting their comprehensive role in market development and customer engagement. Understanding these distinctions is essential for multinational enterprises to ensure compliance with transfer pricing regulations, optimize value chain efficiency, and adapt to evolving economic and regulatory environments. Properly documenting the roles, risks, and rewards of each entity is not only a regulatory necessity, but also a critical step in building sustainable and efficient global distribution strategies.